Net Lease REITs and family offices are sitting on billions of dollars of dry powder right now. And the first call on their acquisition list is healthcare. Not because they love medicine, but because healthcare tenants have the single highest re-tenanting cost than any tenant category in commercial real estate. And here's what that means for you. You can have two separate operators own the exact same identical building, charge the identical amount in rent, and heck, they can even operate an identical clinic and walk away from a sale-leaseback with proceeds differing from $500,000 to $1.5 million per location. And most operators do not learn that until they're already at the table with the buyer who priced it for them. I've spent my career developing, leasing, and structuring these deals on both sides of the table. Today, I'm putting you on the buyer side of the deal, so you fully understand what they see, how they price it, and what you need to build before that time comes. The switching cost thesis. Institutional capital allocates to one variable above all others, the cost to replicate the income stream. The higher the barrier to vacancy, the safer the asset, the more premium the pricing. And healthcare has the highest barrier in net lease. A clinical build out runs between $150 to $350 a square foot. Medical grade electrical, specialized plumbing, HVAC zoned specifically to patient rooms. At 3,000 square feet, that's $450,000 to $1 million embedded in the building if a tenant decides to leave. For an institutional buyer, the switching cost is not a detail. It is their thesis. And it's why healthcare net lease pricing can be priced between 50 to 250 basis points tighter than retail. And it cuts both ways. That switching cost can work in the tenant's favor at the renewal period and work against the tenant if the lease is structured poorly. Because a healthcare tenant operator at renewal has nowhere cheap to go. And understanding that when the time is right is critical to your negotiations. When an institutional buyer underwrites a healthcare net lease, they run a matrix, not a gut check. 3 layers. And if you've never seen it from the buyer's seat, this may change how you structure leases going forward. The primary metric is EBITDAR coverage. That's the earnings before interest, taxes, depreciation, amortization, and rent, divided by the annual rent. A retail lease may clear at about 1.5x, while a healthcare buyer is looking for 2.5 to 3.5x for coverage ratio. An example is $600,000 in EBITDA, $200,000 in rent, so that's $800,000 divided by the $200,000 and you have 4x. That's a fantastic EBITDAR coverage. And here's the part that connects to everything else in the video. You see, coverage is not just a pass-fail gate. It is the single biggest input in the cap rate that the buyer assigns. Strong coverage signals a low default risk. Now, low default risk is exactly what compresses the cap rate and allows for a higher price. Coverage below 2.5x doesn't just risk a pass, it pushes your cap rate up and pulls your proceeds down. And hold that link because this next section is where we put it into dollars. Layer 2, remaining term. Buyers need runway. They're looking for 15 to 20 years of remaining term. We're talking the base initial term before they'll put a premium on your lease. A lease with 4 years remaining and a 5-year option, well, that's going to be underwritten as a 4-year lease because the tenant has the option to renew. It's not a guaranteed 9-year term. At year 9, the landlord has full repricing power and the buyer, well, they're going to underwrite for that. If you saw the video breakdown of when to pull the trigger on a sale-leaseback, you know the PE clock tells you when to execute. The remaining term at the time of that transaction is one of the variables that's driving price. This is the buyer's version of that same math. Layer 3, escalator structure. If you saw the breakdown of the 3% clause, then this is the same framework, but in the buyer's seat. There we showed how a 3% annual escalator, compounding over 10 years, can destroy a healthcare operator's margin. Same mechanics, different side of the table. Fixed 3% annual increase looks great on a buyer's pro forma, but the tenant whose margin erodes due to that clause is a credit risk after year 7. And a failed tenant means a vacant, specialized, dark shell for 12 to 24 months. CPI collars capped at 2% or step-ups based on time. They protect the investor's yield and the tenant's margin all at the same time. That is a structure that both sides can underwrite and earns the best cap rate. If your coverage ratios are strong, but your lease structure, things like escalators, remaining term, or even assignment language, isn't ready for institutional underwriting, that is a solvable problem. I work with operators and capital partners to audit lease portfolios for exactly this. The link is in the description. No pitch, just an audit. Now, we just established that coverage drives the cap rate. Let me show you what that cap rate is worth in cash. Because the gap between a 5.5 cap and a 6.5 cap, well, it's not a rounding error. Cap rate math is simple. The total asset value equals the net operating income divided by the cap rate. Lower the cap rate, higher the price, same income stream. Let's look at an example with $200,000 in net operating income. At a 6.5 cap rate, that's $3,076,000. At 5.5 cap, that's $3,636,000. Same building, same tenant, and the same rent. And that's a $559,000 difference in a single point in cap rate difference. Now let's be precise on exactly what moves that point. Cap rates are impacted based on the rate environment, the asset class, and the deal size, none of which you actually control. But a meaningful piece of that spread is a part of which you do actually control. And we're talking about the coverage ratio and the lease structure. You can control whether your lease earns the tight end of that range or the wide end of that range. And that control, in this example, is worth more than $500,000. If you scale that across 3 separate buildings being sold together, let's say $560,000 each, that's about $1.68 million in additional funds that you've put in your pocket. The only variable that you controlled was the paper, and that is why your lease structure around the time of sale could outweigh any landlord negotiation that you've ever had. What institutional buyers want in the lease. Pulling it together, the institutional investor isn't worried about your clinic. They're underwriting a financial instrument that just happens to be a building. 4 structural elements decide whether it's priced at a premium or at a discount. When I broke down when to pull the trigger on a sale leaseback, I showed on how to build these into the lease from the operator's point of view. Now we're going to take a look at what the buyer sees when they're in place. 1, absolute triple net. The tenant covers maintenance, taxes, insurance, and structural. For institutional buyers, this is the baseline. And without it, they need to factor in management risk. 2, EBITDAR coverage at 2.5x, and ideally 3x or higher. Below that, the buyer may not pass, but they will reprice. And that repricing is coming out of your pocket. 3, predetermined escalators through every option period. Not fair market resets that hand the landlord repricing leverage at the end of the term and potentially makes a tenant a credit risk by the end of year 10. CPI collars or step-ups, the same mechanics behind the 3% breakdown through every option period, not just the base term. 4, assignment language that survives a corporate transaction. If your platform is acquired by a health system or PE operator, then that lease needs to be able to transfer cleanly. Inability to assign is a silent deal killer in healthcare M&A, and it's one of those that the operator doesn't really realize until it's too late. The assignment clause payoff. Here's the element that reprices an otherwise institutional grade asset at the worst possible moment. Assignment clauses that require landlord's consent without limiting the grounds of which that landlord's consent can be withheld. Here's what happens at exit. You're selling your platform to a PE-backed group for $30 million. The buyer's legal team runs due diligence and they find 7 leases with unconstrained landlord consent rights. 7 different landlords, each with consent over a $30 million transaction. 1 demands a rent increase as a price to consent. 2 demands that the assignee sign a fresh 10-year lease agreement as a price to consent. Another just slow walks the response with nothing forced in their hand. The closing window goes from 90 days to 180, and the buyer's financing cost compounds to a point where their decision-making really narrows. Some reprice and others walk. This is the counterparty problem from a different angle. When I covered when to pull a trigger on a sale leaseback, that was from the point of view of finding a buyer that met your operational needs. The assignment clause is where that holds or collapses at exit. The fix is language that limits consent to specific conditions. Creditworthiness of the assignee, continuity of use, and deems consent granted if the landlord doesn't respond within a defined window. That is institutional grade assignment language, and it belongs in every lease before you consider a liquidity event. The through line. Institutional buyers may pay a premium for healthcare assets because it's one of the most durable, vacancy-resistant assets in that lease. The switching cost is real, the credit quality is contractually documented, and the operators who win are the ones who structure for that before they ever need to sell. The breakdowns of the 3% clause and when to pull the trigger on a sale-leaseback gave you the operator's framework, how to structure escalators, when to execute, and how to choose the right counterparty. This one gave you the buyer's lens, how the capital on the other side actually prices what you're bringing to market. Understand both sides before you execute, and you sit across institutional capital and close on your terms, not theirs. If you've made it this far and you're interested in me taking a look at your current portfolio, or maybe considering your growth pipeline, just book a call with me. The link's in the description. Absolutely no real pitch, just happy to help. Watch the breakdowns of the 3% clause and when to pull the trigger on a sale-leaseback. The operator's lens really lives there. This was the buyer's view of the same coin. See you in the next one.